Hey, Coach B here with another episode of Chalk Talks. And before we get deeper conversations about different option strategies and how options are priced, it's important that we get to the basics. Okay, so the last video we talked about call contracts and the basics about them, and today we're going to be talking about puts. So basically, a put contract's the exact opposite of a call. In a put contract, the seller of the put is agreeing to buy the stock at the expiration at the specific strike price. Okay. So in the call contract, it's the buyer that's agreeing to buy the stock or has the option to buy the stock. Right. So, anyways, and the buyer of the put contract is going to sell that stock for that price. I know it may sound kind of confusing, but I like to think of it this way. As the buyer of a put, you want the stock to go down so you can sell it at a higher price. You're going to sell it to the other side of the contract, right? As the seller of the put, you want the stock to go up so you don't have to buy it. Okay, so there's way more strategies involved, but pretty much that sums up both sides of the contract. Who wants what to happen? So let's put this into an example and see if it becomes easier to understand. Using the four basics from every contract that we talked about in the last video, we have the quantity, the strike price, the expiration, and the premium. We can build a hypothetical situation and talk through this. So let's say a stock's trading at $10, right? And you think that stock is going to drop to, let's say, $6 over the next couple months. Matter of fact, let's just say by December, you think this stock's going to go down from 10 to 6 between now and December. Well, you got a couple options, right? You could short the stock. You could short, maybe short 100 shares of that stock, but that would require you to tie up $1,000 of capital. And it puts you at unlimited risk because if the stock rises, let's say it goes up to 11, you'd now be out $100. You lost $100. And even more as the stock continues to rise. If it goes up to 12, 13, 14, that's just hundreds of dollars that you'd be losing. Or you can buy a put contract and profit on the downward movement of the stock. So maybe, okay, let's say, remember, you stock's trading at 10, you think it's going to go down to 6. So maybe you buy a December put and you buy the contract at the $9 strike. And you're going to pay a premium. So, because you're the buyer of the contract, so you're going to pay the seller, let's say, a 50-cent premium for it. So our basics on this contract would basically be 100 shares is our quantity. Strike price is 9. Expiration's December. And you're paying 50 cents times 100. So you're paying $50 for that contract. Remember, that premium is going to the seller, and that's theirs to keep. So we said this stock was trading at 10. You thought it dropped to 6, so let's play out two scenarios. If the stock goes up, let's say the stock goes to 12, what happens? Well, would you want to sell a $12 stock to someone for $9? Not really, right? So you just let the contract expire. And, basically you're out $50. Okay, so the contract expires worthless. You lost $50. That's the 50 you already gave to the seller. That's all you're on the hook for. Now, if the stock goes the other way, let's say the stock goes down like you thought it would. Let's say it goes down to 7. Okay. It didn't go all the way down to 6, but it goes down to 7. A couple things happen. From the buyer's side, you now have the opportunity to sell those 100 shares to the seller for 9. That's what the contract was all about, right? Is that at this expiration date, you have the opportunity to sell these shares to the seller at $9. Well, you don't actually need to do anything. This will just take place for you if you let the option contract expire. But basically, it works like this: you would be buying 100 shares for $700, right? It's trading at 7, and the seller has to buy those from you at $900. $9 strike price times 100, and you're keeping the difference. So basically, on that contract, you made $200, but you also paid out a $50 premium, so your profit would be $150. Basically, when buying puts, you're taking on a fixed risk bet against a stock. You pay a premium now for that contract, and if the stock goes down below your strike price plus premium, that's where you start to profit. If not, you lose, but your losses are fixed at the premium cost. You can only lose what you put out in the premium. You can't lose more than that. When you're selling puts, you're able to obtain a premium up front. Someone's going to pay it to you right away because you're taking on the liability of the contract. In this scenario, you would get paid $50, but you're also on the hook to potentially buy the shares of the stock at the strike price. So again, in this scenario, $9. So as the seller, your investment is fixed because you know what you're going to have to pay if the shares drop. In this scenario, again, it would be 900 for the shares, subtract the premium that you got paid up front of 50. So basically, when you enter into this hypothetical contract we just came up with on the sell side, you know that you're liable for $850. So it's a fixed investment price, kind of a fixed, what your liability is. But at the end of the day, most sellers, that sell the puts, they just think the stock's going to go up and they're going to keep that $50 and just move on, right? The contract's going to expire worthless for the buyer of the put, and they put the money in their pocket. All right. So before we go, let's take a look at the option chain really quick to identify how to read a put contract. So right now we're looking at Disney, DIS. Actually, you know what? Let's change this up. Let's go to MGM. You never want to bet against the mouse. All right, so we're not gonna do even hypothetical puts on Disney. All right, so remember, all option chains might look different. Right now, we're looking at Thinkorswim. So this is how their option chain is laid out, and Thinkorswim's through TD Ameritrade. But regardless of what platform you're in, no matter what option chain you're looking at, they're all going to contain the same stuff. The same basics, and that's what we're going to go over right now. So in this one, let's see, I'll open up this one. We got calls are always going to be on the left in Thinkorswim. Puts are going to be on the right. That seems to be pretty standard in some places will list it where they only list calls and then down below they'll list puts. But either way, MGM right now is currently trading at, looks like $37.62, somewhere around there. So let's say I think MGM will drop below, it's going to drop, $5 between now and December. So I'm going to go out to the December chain and let me see. Or actually, we'll go, December here. We're looking at the MGM option chain for December, and I think it's going to drop, let's say $5 between now and then. So from 37, I think it's going to go down to 32. So we're in the December chain. Maybe I'll go to the 35 strike price, and I'm looking at puts now. Okay, so 35 strike price. That's going to be our strike. Again, December expiration. Each contract's 100 shares. We already know that. So now let's see what our premium would be. So at the 35 strike price, remember you always have a bid and an ask. Bid is what the buyers want to buy these contracts for. Ask is what the sellers want to sell these for. So right now this contract's going for basically $280 or $2.82. Multiply that by 100. You'd be paying $282 to get into this contract. Okay. So in order for this trade to be profitable, if we want to talk about our break evens, we would take this strike price of 35 minus 200 or $2.82 puts us roughly about what 32.18. So somewhere we need this stock to fall down to $32.18 in order for this trade to be profitable at expiration. Why? Because we already, in order for this to work out, the premium, we need to get past the premium, right? So we're already at the 35 strike, but if the stock falls down to, let's say, $32, I would be buying it for $3,200 and then selling it to the seller for $3,500, and that would give us a $300 differential there. But I'm also putting $282 into the contract, so I need it to drop down below that, right, in order for this trade to be profitable at expiration. That's pretty much how it works. I hope that makes sense. And there's a lot more to this. I mean, in terms of trading strategies and when you would want to sell a put, the opportunities that exist when you do it, how options or prices are how they come up with, how each contract is priced, where those premiums come from, and how the stock price affects the premium, along with so many other things. And we'll get into that in future Chalk Talks. But what I really wanted to cover today was, again, how a put contract works. And so if you're buying, you're basically betting against the stock. If you're selling the put, you want the stock to rise. Okay, you're bullish on the stock. So anyways, if you have any questions, if there's something that I didn't cover in here, please put them down below in the comments. If you got any ideas for future topics, again, leave it down in the comments. I read through them, I enjoy them, and I'll continue to make these videos as long as people are liking them and watching them. Which brings me to my next point. Please hit the like and subscribe button to support this channel. I really appreciate it. Also, if you'd like to join me, I'm streaming live every morning at 6 a.m. on the West Coast. So that's 30 minutes before the market opens, no matter where you're at. Talking stocks, answering questions, having fun, watching some of the hot tickers on the day. Thank you. Have a good day. Good luck in the markets.